and welcome to Fidelity Connects. I'm Pamela Ritchie. Donald Trump's return to office is creating a true buzz in the alternatives marketplace. The theme of deregulation within alts could offer more opportunity for the retail investor to gain exposure to private assets. So how might policy changes impact alternative investments, and who are the key players in the private equity and credit space to be taking a look at? Joining us here today to discuss opportunities among alternative investments and the range of products that Fidelity offers in this marketplace is Alternative Investment Strategist Brendan Sims. Great to see you again, Brendan. How are you?
Great to see you as well. I'm doing well, thank you.
Good. Great to have you here to discuss this. This is very timely. We've got the Trump administration coming in for 2.0 on Monday, and deregulation since the election has been a massive theme. Let's begin with actually the expansion of crypto that we've sort of already seen and is expected to continue. I wonder if we can actually look back on 2024, because it was quite a road, wasn't it?
Yeah, absolutely. We'll maybe jump into 24, but we'll try to keep the history lesson brief.
Sure.
If you missed it, I think you should really tune in for sort of the next season if you would. It wasn't one to miss. So 24 actually began in 23 with a lot of the expectation for a few upcoming events that we'll touch on. And most notably, that was the launch of spot exchange-traded ETFs.
In the US.
In the US in January. Fidelity actually was earlier to market by a number of years, beating the US. Doesn't happen often, but we're thankful in this case that it did. Yeah. And then if we jump forward to April, there was the halving event. And for those that maybe are less familiar with what the halving event means, it's something that's hard-coded into the Bitcoin protocol that serves to structurally reduce supply.
Right. Brings in scarcity.
You got it.
Yeah.
It codes in a sense of scarcity. We know that there to be 21 million finite supply of Bitcoin out there, and the halving mechanism occurs roughly every 4 years, or 210,000 blocks if you would, to get technical. But these two events in and of themselves serve to, on one hand, materially increase demand, while structurally decreasing supply. In Economics 101, that led to price discovery at much higher levels than we entered the year with. And the way I would summarize it is the spot exchange traded products, Fidelity, which was one of first to market of the number of different products that were brought forth in the US.
In Canada, yeah.
Well, first to market in the US as well, like with the initial ETFs that were bought on in January of last year, participated to a great extent in what were rampant inflows, some days for the category exceeding $1 billion on a day.
That was quite a day, wasn't it?
It
Yeah,
was quite a number of days, about a year ago, but it led for significant movements upwards in price. That normalized towards the middle of the year. It definitely couldn't go on forever. You can do some quick math and figure that out, but it was certainly an interesting start to 2024.
So there's more to 2024, but what did that event do to the Canadian Bitcoin offering?
Yeah, so they're one and the same, right? They're an exchange-traded product that is gaining access to the underlying asset, which is Bitcoin. So when you go out and you make a purchase into an exchange-traded product, or FBTC, for example, here in Canada, you're gaining exposure to Bitcoin, whereby the ETF is purchasing Bitcoin on your behalf. We are offering custody and storage, which is a whole other conversation. But as far as price, the price moved in the US, it also moved in Canada. Thankfully for 24, there was actually greater price appreciation in Bitcoin thanks to a rise in the US dollar. You're holding Bitcoin, right. You're holding it in US dollar.
So interesting. Okay, so then we fast forward to sort of the fall. The election is looming, and then we see another story take hold.
Yeah, absolutely. So I think that we saw a bit of a lull through the middle of the year, but then a lot of anticipation towards that election came up. And it was really, as Biden kind of began to wane and Trump was looking more and more in favor, that we saw optimism come to digital assets, and more specifically Bitcoin. At face value, I'm not going to get too deep into the politics, but we know that the Democrats to be more frictional towards Bitcoin policy adoption, whereas the Republicans would be more sort of accommodative, if you would. It was actually prior to the election in July. It was at a crypto conference in Nashville that wasn't so well known at the time, but in and around the time of the election and when Donald Trump became president-elect, it was front of the news that he was at a conference in July pretty much saying that he would like to see the US as a world leader, quote unquote, in Bitcoin and other digital assets. So seeing that from Donald Trump coming in, as you say, 2.0, it sounds like he's excited, putting some policies in place, or maybe removing some structural barriers to allow digital assets to be more free-flowing.
So what will that sort of amount to ultimately here, and for investors that maybe have watched some of these offerings unfold? What would you say to the retail investor who's either sitting on the sidelines, kind of watching this all unfold? Is there a little bit of a new era?
I'd say that the era is unfolding in front of you. Like there's the whole buy the rumors, sell the news type event. And if we go back to sort of Q4 of 23 with these two big events that we touched on, the launch of ETFs and the halving, the big question at the time, and you saw the headlines, is this a buy the rumor, sell the news type event? And in hindsight, it turns out it was buy both, or buy the first and double down on the news, if you would.
Yeah.
What the future holds in our house view, I'd say we would defer to some of the bold moves that we made a few years back with our all-in-one products, our all-in-one ETFs, in a sense that we earmarked a 1 to 3% allocation for multi-asset investors to gain exposure to digital assets, more specifically Bitcoin. And I think that's representative of our house view, is that digital assets are a real asset class that is here to stay. We're not making any bold predictions on price like you see some people really sticking their neck out there on. But on a personal level, I could see that I would not be surprised if looking back in 5 or 10 years, you see digital assets compounding at a rate proportionate with other risk assets, but to be at times with a far greater level of volatility, maybe as measured by standard deviation. But I think in a world where it begs the question of markets did so well last year, where do we put new money? How do we diversify? I think the more building blocks you can put into your portfolio, Bitcoin and digital assets being one of them, mind you, with a very prudent approach. Like you can't mess around. You need to sort of monitor these positions. If they do well, rebalance away from them towards sort of other assets in your portfolio. You can let your winners run, but not too much.
Yeah. Okay. Take us back to some of the basics, the cold storage versus hot storage, and ultimately how Fidelity is involved in this.
Yeah, so what comes to mind is Fidelity Digital Asset Services, or FDAS for short. And FDAS is really, in my opinion, the gold standard when it comes to security and custody. And to be completely transparent, when it comes to the measures that are in place, I don't know very many of them. And it's probably a good thing that I don't know them, and nor are we here talking about them. But hot and cold storage is one of them at the very high level. And what hot and cold storage would infer, hot meaning connected to the internet or connected to a digital exchange, cold being offline. 98 some odd percent, or the vast majority of digital assets or Bitcoin that are stored with FDAS would be in cold storage, with a marginal, say 2% left connected or in hot storage, if you would, for transactional purposes, ins, outs, daily liquidity, et cetera.
And I mean, you would need sort of a big name to handle that. I mean, having cold storage in a safe way for sort of a smaller player would be harder.
There would be a number of, call it like tangible and intangible, be it like physical in-person metrics, as well as sort of online and offline type metrics, encryptions, if you would, that would go into the security and custody of any digital asset, even far beyond that of Fidelity Digital Asset Services. But I think we commenced our foray into digital assets as long as I think it was about 2014.
I mean, that's a long time ago.
It's a very long time ago. We're a big organization, we're a private organization, and we are afforded the flexibility to be early and to take the initiative to jump into this space many, many years ago. So a lot of the foundation that we rely upon today, it wasn't built in the last 2 to 4 years when Bitcoin became more popular, brought mainstream to Wall Street, if you would. Like we've been doing this for a long time, I think is the main message.
Yeah, it's fascinating how this might work its way through. We're speaking right now to investors, you're speaking to investors, to advisors, retail investors. There's a whole institutional side of things. And often that will be a really interesting flows story. Are institutional investors pretty interested in Bitcoin at this point in Canada?
I would say no. The needle has moved, but on average, institutional organizations are not at the table with respect to this. But you do see in the filings of these ETFs, whether it be in the States or in Canada, those who have come on board or taken a seat at the table, if you would. And when you look at introductions of large net new flows, it often coincides with a number of these institutions individually or collectively maybe entering into a buying pattern over a quarter to establish what they see as like a long-term 1 or 2% position. And like I said, the market is relatively untapped with many organizations still on the sidelines.
So I mean, if some big players, either pension funds, other institutional investors, really took a look at this seriously, there's quite a long way for them. They haven't done it yet, really.
Yeah, like I mean, you see shareholder letters to large publicly traded companies that we're all very familiar with, like lobbying to say, hey, you have a ton of cash in your balance sheet, maybe you should adopt within your own publicly traded entity a strategic Bitcoin reserve. And the reality of whether these come forth or not you have everything between a company who would never do that, a company who might do that, and MicroStrategies or MSTR, which is doing that in a big, big way. That's the story with Michael Saylor, which we won't get into today, but essentially they're levering the underlying company to gain exposure to Bitcoin and trading at a premium at that to the price of Bitcoin. But it's a very interesting story that's still unfolding daily.
Let's talk a little bit about the strategic reserve currency piece of all of this. Scott Bessent spoke a couple of days ago. I was part of his testimony, incoming, we think, Treasury Secretary for the United States. He talked a lot about how the dollar has to stay the reserve currency, and was asked about digital currencies and whether there was going to be sort of a digital dollar. And he said, no, because we don't need it. That's for countries that don't have a very good currency, basically. That was sort of his message. But let's talk about the strategic reserve currency world, because there are countries that are thinking about having digital currencies. I mean, from their central banks.
Absolutely. So a lot of the kind of price anticipation or movements in market, I'd say over the last 60 to 90 days, have been around the reality that is countries establishing a strategic reserve, and the idea that the United States could one day do that. And I'll just quickly plug in some info that the United States as a nation either was or is sort of the leading holder of Bitcoin by quantity, with about 200,000 coins on their balance sheet.
And that's as of, very recently?
That's as of very recently, and the reason I say was or is it was just last week that it hit the tape that apparently about $6.8 billion worth were set to hit the market for auction, and that was a move made by the current administration.
Right.
So you can kind of see this tug of war between what they're looking to do in Trump 2.0 versus what's currently going on with the current administration. But
there's some real potential there.
Yeah, so like just laying the scene to finally answer your question, but the United States has about 20 billion on their balance sheet, if you would, and much of that was taken from confiscations or seizures, if you would, in the past. And there's discussion about could that be shifted or moved over into a strategic reserve? Like legally, is that even something that can happen? But I think that there are countries out there, Brazil in Q4, introduced a bill, not yet passed to my knowledge, but introduced a bill for something that they refer to as respite. It's the Sovereign Bitcoin Reserve. The bill earmarks 5% of that reserve for digital assets. You have El Salvador, you have other countries like Germany talking about this in a very real way. Mind you, those aren't even the countries that we're talking about that have rampant inflation and big inflationary
Brazil's inflation's
problems.
actually all right.
So we look at countries that have inflation, never mind double digits, but potentially spending some time in the triple digits. And for everyday individuals, it's really important. How do they preserve and save last week's earnings for next week's goods? And I think that really worldwide, the phenomenon is that anyone with an electronic device and connection to Wi-Fi or the internet may or may not now have access to an avenue to preserve those dollars that they didn't have a number of years ago. And I think that's a really good thing. We're fortunate to afford the privilege in more developed markets that a lot of the discussion around Bitcoin and digital assets is around that of a store of value. Compared and contrasted to gold, how's this used as a building block in portfolios? We're not so much worried about preserving our earnings. That said, at the rate that central banks and governments have and are printing money and running deficits, there is much discussion around currency debasement, which fuels a whole other argument for digital assets, but also real assets as well.
To help, talk about that.
To help protect against inflation.
Okay, fascinating. What stage is the regulatory framework right now? What stage is it at now for Bitcoin to go mainstream in the US? You're actually exchanging it for goods or services.
I would say that to a lesser extent, it has been there in the underlying scene for a long time. Like, I mean, on a personal level, I might be speaking uneducatedly on this, but I do see Bitcoin ATM machines at the odd gas station here in Canada. You go to the US, if you're traveling down south, you do see them more and more often. And I would imagine, again, I don't know and I haven't observed this, but depending on the way a state leans, you might see more or less of them. That's just a guess. But I would say that certain organizations, like Mark Cuban being one of them, allowing attendees to sports games to potentially transact with digital assets. You're seeing these early adopter moves. The extent to which everyday conventional businesses build this in, it goes back to price and cost to transact. So if you're earning $100 last week and your groceries are going to cost you $300 next week and you can't afford that, it's great to be able to hedge, and you'll pay whatever transactional cost to get that hedge and gain exposure and to transact in digital assets. But if the transaction cost is high, be it we do have fees on our credit cards, a lot of consumers aren't necessarily aware about that the vendors pay. To the extent that those transaction costs are there, it begs a good question of how seamlessly can we transact and buy a sandwich and a drink using digital assets. And I don't see that coming around the corner in a big way, but I think that there's a lot more of a conversation for digital assets in portfolios.
Okay, fascinating. And this is a way of taking a look at separate assets, the private asset world, also private equity, private credit. It does feel like, we'll move into kind of a different segment here, but this idea that, years ago, Main Street investors were able to get access to what Wall Street invested in via mutual funds, and then came along ETFs, and that was another layer of how you could get access to sort of areas of the market that only Wall Street had access to. It does feel like private markets were the area for hedge funds, for very, very large investors, institutional investors, but now Main Street is getting more and more access to that. How does that fit with what Fidelity is doing? Yeah,
so Fidelity is very much at the forefront of these trends and encompassing private asset exposures into our existing portfolios. And this is not something that happens overnight, right? If we express a desire, it's not like it's in our portfolios in a meaningful way next quarter. That said, it'd be worthy of mention that about 18 months back, we entered into a strategic agreement with Brookfield Asset Management, more specifically in a real estate capacity. And we've been gaining access to their expertise as far as sort of an advisor within the space of underwriting, analyzing the market, and owning private core Canadian real estate. And we can certainly spend some time on that after, but focusing more on the landscape, we are seeing a number of large organizations here in Canada with very established roots partnering with established private asset managers, predominantly from south of the border.
Yeah, so coming out, getting a Canadian partner to then sell to Canadians on a retail basis.
Yeah, so we have Fidelity and Brookfield, and we'll get into some of the aspects that we're most excited about, but you have Brookfield and Carlisle, you have BMO in Carlisle, about that.
And there's others like that.
Mackenzie, Northleaf, et cetera. The list goes on. You have groups like Blue Owl, amongst others, private labels, Blackstone, coming here and trying to lay foundations here in the Canadian landscape. And I think that the retail wealth landscape, both in Canada and the US, is very underrepresented from access to privates. And for a long time, I would say the reason for that has been technology. Okay. You rewind 30 years, like how do 10,000 investors gain access to participating in private deals with smaller increments of capital, maybe less leniency towards being a liquid asset? You can't just buy and sell buildings because someone wants a redemption, if you would. Right. So I think that technology and the infrastructure enabled by technology is playing a big role in allowing the retail wealth landscape today to gain access today and into the future in a much bigger way to these asset classes.
So it sounds like this has been planned, even the agreement inked some time ago. Is there a layer of a Trump administration coming in, mostly this deregulation discussion that we're having, that puts some extra wind in those sails?
Yeah, so there was an article published just a number of weeks ago, and it was really about private equity as a group lobbying for less restriction and more sort of unencumbered access to rolling these plans out. And just to throw a few numbers out there, there's some 12 or 13 trillion in defined contribution plans in the US. And that's the nugget that these groups are looking to tap into. There's 13 trillion unaddressed. We're a 2, 5, dare I say 10% introduction of private asset within said portfolio of 13 trillion in IRAs and 401ks. Don't have the numbers on me for Canada here with the size of that ecosystem, but it represents a big opportunity. And Harvey Schwartz, who's the CEO of Carlisle, I was listening to a podcast about a month ago, but he was on record to kind of share and say that over the next 10 to 20 years, amongst many evolutionary themes, he thinks that tapping into the vein that is sort of the retail wealth channel will be amongst one of the most prominent evolutions sort of in the next 10 or 20 years. And that's a big name.
That's a big name.
At the helm of a $460-some-odd billion private shop who's really excited about this.
Who's identifying the trend and maybe driving it to an extent.
Absolutely.
So tell us a little bit about private companies, probably in Canada too, but in the United States. We talk a lot about the stock market, what's available, how to diversify within, what a 60-40 looks like, and what you put into each side of that ultimately. How many companies are private?
Yeah, so with respect to private companies, the number per Google and through a few reliable sources would say that there's about 25 million private companies in the US alone.
What percentage is that?
There's 25 million, we'll get into that. But mind you, keep in mind, some of those are small mom and pop companies. So we need to apply some form of a filter based on size. So there's about 4,000 and change public companies, just to contrast those two numbers. Wow. But with respect to applying like a size lens, if you would, to that, there's the famous stat that's often quoted that for companies with revenue over 100 million, 87% are private and only 13% are public. And it begs the question today of how do we build portfolios and how do we allocate? 13% of companies have revenue over 100 million, and we know that a short list, be it we name the Mag 7 or maybe say top 20, top 30, are responsible for the lion's share of return across, say, the S&P 500 or a Russell 1000 type index. So it begs the question of, are there many opportunities or stones out there that aren't being turned over? Kind of leads me to the next caveat that there's a ton of dispersion in returns for private asset classes. A lot of people will come around and look at the allure that, quote unquote, like private equity has outperformed public markets. And while that may be true for the top decile of fund performance, there's massive dispersion between the best performer and the worst performer in, say, the private equity category. And that's where manager selection and due diligence processes play a big role. And I kind of joke and say that it's arguably just as hard to pick the top decile of a private equity partner, for example, as it is to pick the leading top publicly traded names for 2025 in large cap names. Like it's a challenging thing to do, and people work tirelessly to due diligence across many sort of private asset managers that they look to partner with.
How different is the research?
I would say it's very different. Like one, you're analyzing financial statements, you're staying attuned with sort of trends, looking and forming theses around sort of what can change in the future. Whereas that work is being done and they're analyzing companies, you're more sort of analyzing the partner themselves and the structure of the vehicle. You don't know necessarily what the next transaction is going to be on a private capacity. You know maybe some historical transactions. There's precedent set with sort of the pedigree of a shop, but you're looking into the terms of these vehicles that you're looking to invest and place capital in.
So we're talking about private assets, which could be a lot of different things. You mentioned off the top there's sort of a focus on real estate.
Yeah.
Just take us there. What type of real estate? Why real estate?
Yeah, so we're really excited about what we've built out over the last, say, 18 months in the Canadian landscape within real estate. Our private investment pools, or our PIP suite of funds, has earmarked a 5% allocation within the private investment pools that are Canadian in nature to gain exposure to core Canadian private real estate. And what I will say is that Brookfield has been an excellent partner to work with. They've gone sort of above and beyond from a due diligence standpoint. They commenced their search for buying private assets actually in 2023 when, rewinding a little bit, the lay of the land, volume-based, it was dry. Like rates were up.
Are we talking about office?
Yeah, we're talking about everything in 2023. Like the spread between bid and ask being sort of what buyers were expecting was still very much on 2021 or early 22 terms.
There were no sales.
There
was nothing pricing.
I mean, we don't have a chart here, but if you had a bar chart, it would be a meaningful drop off from 22 and then into 23. And 24 picked up in a meaningful way. So what I would say is that they did due diligence on north of 30 different properties prior to purchasing their first asset that their private investment pool owners, holders, if you would, gained access to. And it's that due diligence process that we're very fortunate to have a partner with that pedigree. I mean, if you think about it, Fidelity here in Canada, while we would love to, it's extremely challenging to hire, say, 40, 50, 60 employees and build out the capability overnight.
For real estate,
for real estate specifically. We're very fortunate to tap into who we believe is a world leader within the space with Brookfield.
And I mean, the next logical question is this on offer at this point? Later, is there a product attached?
Yeah. So this is within our private investment pools that investors are able to gain access to this. So I think that kind of speaks to where our head is at a high level with Fidelity. That we think there's very much a spot earmarked in multi-asset portfolios or any given investor's portfolio to access vehicles and asset classes of this nature. Private real estate being an interesting one. Yes, there might be some degree. People will say, like, why wouldn't I just buy a REIT? Or I've actually gotten the question, why wouldn't I buy Brookfield's stock individually? And there's some very blatant and obvious answers around that. But the buildings that you're owning are here in the Canadian landscape. They're truly unique, and they're owned by that entity. and the tenants of those buildings, the management of those buildings is sort of owned on behalf of unit holders and performed by Brookfield on our behalf.
Fascinating. Okay, what is the expected impact on mutual funds with private equity or credit entering Canadian markets with a little bit more veracity?
It's a good question. I mean, one could maybe draw parallels to that of the entrance of ETFs. Like, we've seen prolific growth in ETFs, albeit mutual funds sat here, ETFs sat here. Mutual funds are still, yes, there's been some inflow years, some outflow calendar years. I don't really see like an overnight rip the scab off blowout in allocations to fund new positions, nor do I see the availability of these new positions in private assets coming about overnight. Like, anything to this magnitude and of this nature, it's going to be very slow. It's going to happen over time. Will there be an inevitable trend looking back in 10 years? I would think yes. But with respect to sort of concerns towards cannibalization from the mutual fund landscape, I think there are thousands and thousands of investors out there that don't necessarily have the liquidity profile to access private. So while there is say some 13 trillion in long-term assets in the States that are 401k and IRA type plans, when we talk about a lot of AUM, there's the infamous stat that most assets are actually held in non-registered accounts.
Right, really interesting.
As opposed to long-term retirement accounts.
Speak to the future of Bitcoin in Canada specifically. As you mentioned, there was a bit of a jump start here.
Yeah, there was a bit of a jump start. There were a few early movers, and Fidelity actually was not one of the early movers to come into the space. Be it said that in 2024, Fidelity and FBTC, or Fidelity Advantage Bitcoin, we were a leader in net flows for the category to a wide margin at that. And I kind of joke, and I refer to Canada, for those not familiar, Grayscale or Grayscale Bitcoin Trust, it was the former sort of leading exposure in the US, dominant way to gain access to Bitcoin prior to the launch of spot products last January. And I call it the Grayscalification of the North because Grayscale was priced aggressively higher than other competitors. In light of the new introduction of these lower cost spot ETFs, they sort of thought, like, let's try to hold investors captive. Let's keep our management fee high. Let's keep our MERs high, with the idea that there's a ton of unrealized capital gains. Well, it turns out that they lost a ton by way of not AUM, because price appreciation held that up, but they had massive outflows for a period of time until things stabilized. And what I would say, that's kind of what we're seeing here in the Canadian landscape.
That's interesting.
There are some early movers that have garnered the bulk of the AUM, but they're priced aggressively higher from an MER standpoint. So when I look at the space and I do my due diligence across the Canadian landscape, there's only a small number of products or exchange-traded products, less than in the US. And FBTC, Fidelity Advantage Bitcoin, is a clear leader in the space. I differentiate the space based on a few different pillars, one being price, brand and reputation, and then lastly is custody and security.
Fantastic.
And when it comes across those pillars, I would say that Advantage Bitcoin is certainly a leader across all three.
I think we'll have to leave it there. There's so much more to speak about on each of these different areas. But Brendan, thank you for your time. Thank you for sharing your thoughts here today.
Thank you very much for having me.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.